second part of the video about market fundamentals to prepare you for the upcoming investment challenge focused on sustainability. It's Federica and
Pasquale, connected from Milan.
We are part of the Titanium team, the replier team behind the Reply Investment Challenge. But we are not alone, guys. Let's welcome our colleagues from the Titanium team too. Oksana. Hello, Oksana.
Hey guys, it's nice to be with you today. It's a pleasure for me to be here and to introduce to you the part on equities and options. I'm from Avantage Reply, based in Luxembourg, so let's get started.
Wow, okay, cool. In this video, we'll have a general overview about equities, options, and some tips and tricks. But now it's time for equities. Oksana, what is an equity instrument?
Generally speaking, equity, or how we call them stocks, represent the value that would be given to stakeholders if the company were liquidated and all debts were paid off. In the equity market, investors buy stocks or portion of the ownership of the company, which the company then uses to fund their growth. This growth can contribute to increase in the stock value, which then investors can reuse by reselling their stocks at a higher price compared to the price they paid when they were buying those stocks. Now let's talk about how we can value an equity. Valuing an equity can be tricky because it depends on the market fluctuation. Besides a stock price, there exist numerous indices and ratios that can help you to evaluate the health or financial health of the company. So let's look at a few of those. So, for example, you can use working capital, which is a measure how well a company can pay its current debt. Then we can look at a quick ratio that measures the solvency of the company, meaning the ability of the company to repay its outstanding liabilities when they due, using only the assets that they can quickly convert to cash. One of the favorite measures on the market that you can find is earnings per share, which is a measure that evaluates the net income per share gained by the company. We can talk about price to earnings, which is the price that investor is willing to pay for a company share based on the past and actual earnings. Last but not least, debt to equity ratio measures the financial leverage of the company to better understand if the company has a high level of borrowing. Generally speaking, these ratios combined with a lot of our ratios are used together by investors to analyze the performance and financial decisions that they make. The values of these ratios and indices should not be considered as good or bad. All of these values should be treated in a relative term, and they depend on the types of the companies and the sectors these companies are operating in. Okay guys, now let's look at some tips and tricks. Well, first of all, learning is key. Understand what training and trading techniques are good for you. Don't put all your eggs in one basket. Diversification is a key. Practice, learn by doing. This is why we're here. This is the investment challenge. So try your best and learn from it. Know yourself. Understand how much risk you are able to bear and go with it. Last but not least, keep up with the news. Understanding what is happening in the market and in the world will help you to make a better decision and to optimize your portfolio.
And here we go with an overview about options and some main features. Oksana, it's your turn. Let's start first with an easy peasy question. What is an option?
Well guys, options are versatile derivative products that are based on the value of the underlying asset, for example a stock. In each option there are two counterparties. The buyer who pays an option cost, called premium, for the right granted by the contract, and the seller, the actor who will receive the cost of the option, but also the one who will be obliged to execute the contract in case the option is being exercised, or what we call it, in the money.
And what types of options are there?
Well, there exists a lot of ways how we can classify options. First of all, we can look at put and call options. A call option gives the holder the right to buy a predetermined amount of the underlying asset at a predetermined price, called the strike price, at by a certain expiration date. On the other side, A put option gives the holder the right to sell a predetermined quantity of the underlying asset at a predetermined price, called the strike price, by a certain expiration date. Now, let's look at the second classification, American versus European options. American option can be exercised at any time before the expiration date of the contract, while European options can only be exercised at the expiration date of the contract. So when we talk about exercising, we're meaning that you can use your right to buy in the case you hold a call option, or your right to sell in the case that you hold a put option. Generally, you can take two positions with an option. A long position, meaning when you buy a put or a call option, that's gaining the right to exercise the contract. And you can engage into a short position when you sell a put or a call option that's being obliged to execute the contract if the contract is in the money.
And now an interesting one. What do you need to consider when trading options?
Well, you need to consider the cost, the upfront fee that you need to pay to use the contract. You need to think about the daily trading volumes and also interest in the option. Levels of the risk. You need to consider the strategies of the options and whether these strategies are compliant with your objectives and your risk constraints. Last but not least, volatility. So you need to understand how the large price movements can impact the value of your underlying asset. But be careful. Just because the value of the underlying asset might be moving towards the direction that you want it to move, that doesn't mean that the option will reflect the same move of the underlying asset.
What about buy to open and buy to close and
sell to open, sell to close?
Oh, that's a really good one. So then let's look at each of these points in a detail. So if you are engaged in a long position, you will be engaged in buy to open order, which is used to purchase the contracts, meaning it can be used to purchase call options or put options, depending on your perception on the changes of the value of the underlying assets. This buy to open order must be closed, and for this we're going to use sell to close order, which then closes the existing long position. Now, as we discussed before, we have long and short position. So on a short position, to open a short position, we will use a sell to open order that is used to open a short position. It can be used to sell a call option or a put option, again, depending on your expectation of the changes of the underlying asset of the contract. And of course, we also will need to close this option by executing buy to close order, which will then exit the short position. Well, I think that's it. That was a pretty brief discussion around options, and we hope that we give you a brief introduction that will help you during this investment challenge. And for more information, look at the learning section of our challenge. And for you, Federica and Pasquale, thank you for having me today. Bye, guys.
Thank you, Oksana. Okay, guys, that is all for this episode. We hope you enjoy it and find it useful. For further questions or doubts, you can contact us at challenge@reply.com. If you haven't done it yet, register for the Investment Challenge 2022. Have fun and see you at the next episode. Bye.
Bye.